There's literally millions of dollars sitting in an SEC portal right now, and some of it might be yours. And we're not talking about loose change. We're talking about unclaimed dividends that could be the difference between getting approved for your mortgage or being rejected. Hey, I'm Naim, and on WealthFrame we break down mortgage strategies that actually work. Today we're connecting a dot that most financial advisors completely miss. Unclaimed dividends are not just free money, they're a down payment accelerator that lenders care about. Let me be direct. If you've ever inherited stocks, worked at a company with a retirement plan, or your parents owned shares before they passed, there's a real chance you have unclaimed dividend payments sitting in government custody. And the SEC literally has a portal where you can find it and claim it. But here's why we're covering this on a mortgage channel. This money doesn't just appear in your bank account. It has tax implications, liquidity timelines, and strategic placement value that directly affects your down payment strategy and mortgage qualification. Get this wrong, and you're leaving money on the table right when you need it most. Section 1. What is the SEC Unclaimed Dividend Portal? Let's start with the basic mechanics. When companies go through mergers, reorganizations, bankruptcies, or just administrative changes, dividend payments sometimes get lost in the shuffle. Shareholders don't receive them. Accounts go dormant. And that money? It ends up in state custody through something called the Unclaimed Property Program. Now, the SEC doesn't technically hold all of this. Most unclaimed property is held by individual states. But the SEC maintains databases and works with FINRA to track securities-related unclaimed dividends specifically. We're talking dividends that were paid to brokerage accounts, transfer agent accounts, or investment firms that lost track of the shareholder. How much are we talking? Nationally, there's over $58 billion in unclaimed property, just sitting there. And dividends represent a significant chunk of that. Here's the pattern. Let's say your grandmother owned 200 shares of a company in 1995. She passed away in 2003. The stock went through a corporate restructuring. Nobody updated the contact information. Quarterly dividends were paid, but they went to an address that was never forwarded. After 7 years of dormancy, boom, that money gets turned over to the state. It sits there for decades. Your family never knew it existed. Now fast forward to 2024. You're trying to buy your first home? You need $15,000 more for your down payment. You're $15,000 short of crossing that 15% threshold that would eliminate PMI. Suddenly, you discover your grandmother had $12,000 in unclaimed dividends sitting in state custody. That's not coincidental timing. That's financial breathing room. Section 2. How to actually find unclaimed dividends. Okay, let's get tactical. There are 3 main ways to search. Method 1. State unclaimed property databases. Every state has its own unclaimed property portal. You go to your state's website, search your name, and you'll see what's sitting there. The catch? Each state maintains its own database. So if you lived in 3 different states, you need to check all 3. Most states use a centralized site now called missingmoney.com, which is a free aggregator. You search once, it queries multiple state databases. Takes 5 minutes. Method 2. FINRA broker check and the SEC ***. If the unclaimed dividends are tied to a brokerage account or investment account, they might show up through FINRA's system. You can search FINRA Broker Check online. This is specifically valuable if you had dormant accounts at major brokerages. Method 3. Corporate transfer agents. If you inherited stock or had direct stock ownership, the company's transfer agent might hold unclaimed dividends. This is manual work. You need to contact the company's investor relations department directly. But here's what matters for your mortgage strategy. Once you find unclaimed dividends, claiming them takes time. We're talking 30 to 90 days, sometimes longer. So, if you're in active mortgage underwriting, you can't suddenly claim dividends and use them same week. You need to plan this into your timeline. Section 3. Unclaimed dividends and mortgage qualification. Now, why does this matter to your lender? When you apply for a mortgage, lenders look at 3 things: income, assets, and liabilities. Unclaimed dividends are technically an asset recovery. They don't increase your income, but they can increase your liquid reserves and down payment amount. Lenders actually like this. Why? Because it shows. 1. You have financial discipline to trace and claim money. 2. You're looking at all available resources. 3. The money is verified through government records. It's different from a gift from a family member, which comes with its own restrictions and documentation. Unclaimed dividends are your money that you're claiming. Here's the strategic play. If you're $10,000, $20,000 short of reaching the down payment threshold you need, unclaimed dividends can close that gap. And because they're documented through state records, your lender can verify them during the underwriting process. The timing matters, though. Most lenders want to see the funds in your account for at least 60 days before closing, so you can't claim dividends 2 weeks before your closing date. Also, and this is important, unclaimed dividends have tax implications. When you claim them, the state sends you a 1099 for that tax year. You owe income tax on those dividends. We're talking 15 to 37% depending on your bracket. So if you claim $10,000 in dividends, you might owe $2,000, $3,000 in taxes. Factor that into your strategy. Claim the dividends early enough that you can pay the taxes and still have the remaining amount for your down payment. Section 4. Combining this with broader down payment strategy. Unclaimed dividends aren't a magic bullet, but they're part of a broader down payment acceleration strategy. If you're building toward a down payment, you should be 1. Checking for unclaimed property, what we just covered. 2. Reviewing old 401k accounts and SEP IRAs that might have rollover options. 3. Looking at your home equity if you already own property, HELOC strategy. 4. Analyzing whether FHA loans, 3.5% down, make sense versus conventional, 5 to 20% down. 5. Timing your purchase against your local market dynamics. Unclaimed dividends fit into step 1. It's the low-hanging fruit that takes minimal effort and can unlock real cash. Let me give you a real example. Sarah was a first-time buyer with a $250,000 budget in a HQL market. She had $35,000 saved, 14% down. To avoid PMI, she needed $50,000, 20% down. That's a $15,000 gap. She found $8,000 in unclaimed dividends from her father's old brokerage account. After taxes, she netted $5,500. That brought her to $40,500, still short, but closer. She then opened a 0% APR credit card to cover the final $9,500, paid it off during the first year of ownership, and eventually refinanced when rates dropped. The unclaimed dividend discovery started the whole chain. Section 5. What to watch out for. A couple of critical warnings. Scams are real. If you get contacted by someone claiming they found unclaimed money for you and need a fee, that's a scam. Legitimate unclaimed property claims are free. The state doesn't charge you to claim what's yours. Processing takes time. Don't count on unclaimed dividends if you're closing in 30 days. Plan 60, 90 days minimum. Tax planning is essential. Coordinate the claim with your tax professional so you're ready for the tax bill in April. Documentation matters. When you claim unclaimed dividends, keep every receipt, every letter from the state, every tax document. Your lender will ask for proof. Closing and CTA unclaimed dividends are invisible to most homebuyers, but they're a real asset that can materially change your down payment trajectory. Spend 30 minutes searching state databases. You might find nothing, or you might find thousands.